I consider myself to be a very experienced dividend investor. I've been investing for dividends for over 20 years. I know what I'm doing. That said, one of the keys to my success has been remaining humble, remaining very humble. Even though I have built a really nice sized portfolio, I remain humble because I'm always receptive to new knowledge. And that is what happened. Last week, I held a meetup, a PPC and dividend investing meetup in San Jose, Starbucks, Santana Row, one of my favorite places. Love Santana Row. And this was a last minute meetup, real last minute. In fact, I will link in the description below. If you want to stay apprised of meetups, check that out. I'll link to it in the description below. I have a local crew that you can sign up for. And that local crew, honestly, you may want to sign up even if you're not in the Bay Area, if you're in California, because I'm traveling all over California. I share on that list when I'm having meetups. Anyways, I did this one last minute, literally 2 nights before. 2 Thug Life investors were able to make it. And what was great is I was so impressed. One of these subscribers I already knew him from a prior meetup. And so when I'm saying those, both of them, both subscribers who showed up, both community members, they brought their A game. I am serious, A game. And I was impressed. And this is why it's so important to remain humble, because I go into this meetup, I literally have people coming in who are experts, who are very knowledgeable investors, who are true Thug Life investors, and they brought so much value. And by collaborating, we all grow. And so that is one of the huge takeaways from today's video, is to always remain humble in your investing, because this community is strong, and by coming together we can all learn from each other. And I'm here to say I learned new stuff from our meetup, from these other investors, and I hope they learned some things from me, and we all shared some cool ideas. But that was awesome. And so I know a lot of you cannot make the meetups, even local people. It's hard with the timing. The purpose of today's video is I'm going to surface all of the insights. I want to surface the knowledge that we discussed. I want to surface some of the discussions we had around tech stocks. I want to surface discussion we had around sin stocks. I want to surface discussion we had around Peter Lynch and investing in brand names and trends and so much more, in Bitcoin. The list goes on. There's something about the South Bay. There's something about that San Jose area that it attracts the best of the best when it comes to technology. And that's exactly what I learned actually in the last meetup, is both subscribers brought their A games, brought a world of knowledge in the technology space. I want to share that with all of you as well. So get excited. This is going to be an amazing video, amazing dividend investing video, a recap of our PPC Ian meetup last week. Okay, so I want to start off. One of the first things that we discussed in our meetup were, what are the current values right now? Because we all came from different backgrounds at this meetup, but one thing we all agreed on is dividend investing is awesome. It is the best. We love cash flow. And we were just discussing what are the values that exist in the stock market right now. And so I'm going to put them up on the screen right now. I'm going to share with you the value stocks, the value companies that we discussed. And this should not surprise anyone, but we started off with the sin stocks with Altria and Philip Morris. And you can just see, obviously, Altria now with the 8% starting dividend yield. They just raised the dividend by 5% recently. The forward PE for 2019 is a 10. The forward PE for 2020 is a 9. And so the way I calculate those forward PEs, by the way, is I go to Yahoo Finance, I take the consensus analyst estimates, I take the current share price, I divide by the consensus analyst EPS, and I get the forward PE. And so this thing is trading at bargain basement territory. I don't want to go into it much. I'll link in the description to my last video. We discussed this at length in my last video. But we talked about Altria, we talked about Philip Morris. One of the insights that came from the meeting, and this was interesting because where I work now, I don't work at a tech company anymore. I work in the real estate industry. And I work in a more entrepreneurial, scrappy environment. And so I don't have the exposure that I once did when I worked at big tech companies and I had hundreds of coworkers and I would be in a big corporate office. But one of the knowledge that was pieces of knowledge that was brought to this meetup is that the folks who did attend, these are people who have maybe a little bit more visibility into what's going on in the community, a little more visibility as to what's happening in just Silicon Valley. And one thing that was interesting was an insight that was brought up was, hey, yeah, everyone talks about the fact that no one uses these products anymore, but you know what? At a lot of these tech companies even, there are people using these products. And so that's just something to be aware of. That was an interesting insight that, yeah, it's a market on decline, but there are people here in the greater Silicon Valley using these products, even in a tech company type environment. And so just an interesting insight worth noting. Now, as we're on the topic of these sin stocks, and look, this isn't only sin stock investing here on my channel. This is dividend investing for everyone. But I want to bring something up because on Friday last week, there was a very important tweet by President Donald Trump, and it backs up some of the information I was sharing in the last video. So in the last video, I shared a flow chart. I'm going to put it on the screen again. Basically, my hypothesis, and I could be wrong, is that with all of this talk about Juul and with the vape, my belief is that the winners are going to basically, or the winner in the United States will be Altria. And I believe that because I believe the market's going to be heavily regulated. I think what's going to happen is all the small players are going to get forced out. And I think there's going to be one or two very large regulated players. I think these large regulated companies are going to have to pay hefty taxes. They're probably going to have to even pay penalties for whatever money they've earned before. Who knows? The government will find a way. But what will happen is the government will win the most. The second most will be these companies. And so I believe the big regulated companies that have the connections with the FDA, that have the ability to quality control their products, if you will, they will win. Ultimately, the consumer will win too because it will be a safer product, a safer market, which is awesome. But anyways, that was what I shared last time in the flow chart. And as soon as I kind of finished this video, look, I'm getting good at this, but this is why I want to stay humble. I want to stay humble, but I also honestly have to pat myself on the back here a little bit, and we'll see how this all plays out. Well, I have another subscriber email me telling me I'm flat out wrong on this stuff, should have sold. Hey, time will tell. Let's check back in 10 years and see where we're all at. I don't care about share price. I care about my cash flow. I think my cash flow on these sin stocks in 10 years is going to be quite nice. Anyways, I'm going to put President Trump's quote on the screen right now so you all can read this quote and check it out. Basically, my belief is this quote backs up what I was saying in my flow chart. And so what I'm so excited to see is he's literally, everyone was getting scared. Everyone thought, hey, Juul is going out of business, this and that. No, what he's saying is he wants to clean up the market. He likes the market. He thinks that it is going to be a safer alternative, a better alternative. But what he's saying is we need to clean it up. We have to protect the children. And so ultimately the way, how can we possibly do that? It's going to be through big companies that have quality control, that can work with the FDA, they can work with the government, they can make it happen. So anyways, I just want to share that tweet because that tweet, in my opinion, is totally my flowchart playing out in real life. That said, we're in really early innings of this game. We'll see what happens. It's a high-risk game, and anything can happen. These stocks carry tremendous risk. We'll see. But definitely wanted to point that out. So anyways, we also talked about, obviously, 3M as a value stock. Now, with 3M, one of the things that was interesting to see is they did increase the dividend recently. We talked about that, or relatively recently. We talked about the forward PE. Forward PE, honestly, on 3M is not as nice as the others. But what I did after the meeting is I looked, hey, what's the forward PE for 2020 as well, not just 2019? And if the analysts are right, it dips down into the 16s, the high 16s. So I still feel 3M is a reasonable value. We talked about AbbVie, which is honestly a steal right now at a 2019 forward PE of 7.95. 2020 to 7.43 doesn't get much better than that. Now, what I'm excited about AbbVie is they're yielding, 6% now, 6.1. Last dividend increase was 11.5%. Now, what I'm getting ready for is another dividend increase. I am getting ready for that as an AbbVie shareholder. It should be just around the corner here. I think it'll be very telling what the next dividend increase is. If it's like 2%, hey, that's not really exciting, AbbVie. But if it's another, say, 8% or more, Thug Life AbbVie, we love you. So we'll see what happens. We talked about Johnson & Johnson as well. And I think one of the things that was expressed at the meeting is this tends to be a stock that it's my number one favorite dividend stock. And it seemed for the other investors who attended, hey, they were quite fond of this company in particular as well. It's a bellwether, if you will. It's a very important company to dividend investors. And so what was exciting here, and again, the PE forward is a 15, and in 2020 it dips to a 14. So what's not to like about that? A lot of people get scared about the lawsuits. We've talked about this in the past. Just does not faze me, doesn't scare me at all. And so that said, it does scare me when I look at the portfolio overall, just because there's more of that stuff going on these days. That's why diversify. But for this company, for J&J, doesn't scare me. So one of the things that was just so exciting about this was just off the bat when we discussed which stocks are the values right now, we kind of had a similar list, and this was 3 people coming from very different walks of life, very different job backgrounds. Hey, we're just all different people. And so to come together around dividends and to believe that some of the values that are out there, at least for dividend stocks, are some of the similar names, that was really exciting to see. So that was the first thing we did in the meetup. Now, interestingly enough, one of the attendees that came brought up a topic, and the topic that was brought up is, hey, what do you all think about FAANG stocks? And so what was really interesting in this meetup is, you've probably seen this on my channel, I kind of have a closed mind when it comes to FAANG stocks, kind of a closed mind. Now, I do own Apple, and I love it because they pay a dividend, but the other FAANG stocks, the Facebooks, Amazons, Netflix, Googles, I don't have those. And so I don't do those. That's not for me because they don't pay a dividend. But what's interesting to see is I have a closed mind. I'm all about the dividends. That said, I kind of sometimes do non-dividend. We've talked about in the past, I got some Bitcoin and I do some angel investing. But it was just interesting to see that the other subscribers, the other investors who showed up, they weren't so closed-minded on FAANG stocks. And in fact, there was an appreciation, if you will, amongst the group of the FAANG stocks. There was an appreciation that, hey, there's a transition of wealth happening here from old world to new world. Hey, there's something really special happening in our economy right now, in our world, that is not going to reverse. It's not going to change. The tech is only going to get bigger and better. And it's going to play even more of a daily role in our lives. And so this kind of got me thinking. This is why I like being around other people, other investors, and not only other investors that have a dividend background. Because look, I can go out, talk to friends who just do growth stocks. That's different because that's oftentimes a very different mentality. But to come together around the topic of dividends, and then to have people start talking about tech, have an appreciation for tech, have an appreciation for FAANG, that tells me something like, hey, Ian, maybe you ought to pay a little closer attention to the tech than you are. And so I use these meetings and I use the community as a way to critique myself and as a way to grow my own knowledge. Anyways, when I got home, I just want to start looking at the FAANG stocks because I haven't looked at them for a while. So I'm going to share it on the screen. And I think it's important as a dividend investor. I did a little bit of this in my last video just to compare how do the FAANG stocks on a valuation basis compare to dividend stocks. And the reason you might want to do that is, hey, are the dividend stocks getting too expensive? Are the so-called value stocks not values anymore? Because we all know that some of the dividend stocks are really expensive right now. Talked about some of them in my last video. But anyways, it was useful to look at these. So like Facebook, for example, right now, the forward PE for 2019 is at a $29. Forward PE at 2020 is 19 forward PE. And so this off the bat was a little surprising for me. I didn't realize that Facebook PE valuations, forward PEs, were so low. Now, 2020 is out there. I don't know if the analysts are right, but still to see it heading in this trajectory, that it's at almost a 30 now and it's going to drop to a 19 in 2020, that is not bad. That is not a bad valuation. And so the other thing I want to point out about Facebook that I think you'll see as I go through this video more, this is a tech investing insight. This is a concept we talked about, this kind of leap of faith. When anyone invests in tech stocks and makes a lot of money, usually it's really early in the game. And really early in the game, usually it kind of involves a leap of faith, kind of like I have with Bitcoin right now. And the reason for that is you want to buy low and appreciate like a 10x return or more. What's going to, in terms of capital appreciation, to achieve that, it's usually not after the company's figured everything out. It's usually when there's no risk. It's usually when there's a lot of risk and the company hasn't figured it out. And so I just want to remind everyone here that in the early days of Facebook, when it IPO'd, they didn't have a good revenue model. When Facebook IPO'd, the stock went down. It was not doing very well. They didn't understand at the time if these ads were going to pan out. And quite frankly, at the time, the ads that they offered, as a digital marketer, I can attest to this, were not working very well from an ROI standpoint. But what happened is savvy investors took a leap of faith with Facebook. And I'm not saying this is not without risk. This is very high risk because they weren't making money. But over the years, they perfected their revenue model. They perfected their ability to make these ads work, and it attracted a lot more advertisers. And now they can win. They can win at this advertising model. And so it's just so interesting to see that after all these years, Facebook as a company has changed so much from a revenue, from a earnings standpoint. But the people who made a lot of money getting in really early, they took a leap of faith. Back then, no one even knew if the ads would work. No one knew if they could sell these ads because literally the ads they did have were not working. They were not producing a good ROI for advertisers. But now they are. And so that's that concept of leap of faith with tech investing. Look, you're not going to find me taking leaps of faith too often in doing this kind of thing, but it opened my eyes. It was nice to be around other investors who look at things a little bit differently than I do. That's how we stay humble, and that's how we all grow as investors. And so that was just a side tangent with Facebook that I wanted to share from my own life. As I remember when it IPO'd, I remember it very vividly. And I remember back then when they were having struggles with their revenue model just because of the whole ad revenue model wasn't perfected the way Google had perfected it. And so moving on, Amazon, by the way, I highlight Facebook because I think out of the FAANG, it's probably one of the better values. Now, Amazon, this is just one. Other investors at the meetup were more fond of Amazon than I am. I guess the challenge I have with Amazon is really a valuation one. To me, when I look at this, it just seems like the valuation is just really, really high. And obviously, I'm not looking at all the metrics here, but just from a 2019 forward PE, it's at a 78. And 2020 is at a 55. And so this thing, let's contrast that. AbbVie is at a 7. Altria is at a 10. And so, and they're paying hefty dividends. They're cash flowing like crazy. They are printing money at those companies. And obviously, they don't come without risk. But by contrast, Amazon is trading really high. Now, Apple, I was happy for this meetup. So I'll tell you, when you go to a meetup, I hope I get to meet all of you one day. When you go to a meetup, here's what I recommend. Take notes. When you go home, review your notes and almost create exercises for myself, create projects, if you will, from the meetup. So when I got home from the meetup, I wanted to look at FAANG stocks. That's what I did. It surprised me what I'm seeing with Apple. And so Apple right now pays a really small dividend of 1.4%. Last increase was kind of low at a 5.5%. They got room though. They'll be increasing their dividend. Don't you worry. But here's what I like. The PE right now, 2019, is at an 18.76, 2020, 17.20. Apple is trading a lot cheaper than some of the dividend stocks I own, like McDonald's and Clorox, for example, and Procter & Gamble, some of my bellwethers. And so just doing this simple exercise was, and I'll tell you something, Apple is underallocated in my portfolio. It's a project stock. I need to bring it to size. I need to bring it bigger. Even though it's run up a bit, it may not be a bad time to throw some more money, for me at least, in Apple. When I look at my 42 stock portfolio, it may not be a bad idea. And so that was a cool insight that I took away from the meeting. No one even discussed this in the meeting, but it was because I was talking about investing with other people, it gives me ideas. And this is why the meetups are so important. So Netflix, oh my gosh, I can't even look at this. But what was great is there are people in our community who will look at a stock like this, and to them, they see something different than what I see, and I love that. That's what I love about meeting with other investors. But with a forward PE of 90 and 2020 at 51, I just can't get into that territory. It's kind of like Amazon. So people sometimes ask me, Ian, if you had to buy a tech stock and it didn't pay a dividend, which one would it be? For me, it would probably be Alphabet, aka Google. And so the reason being is just, I feel like you got a good combination of staying power, you've got a good combination of growth, and you've got a good combination of valuation. So it's not valued out of this world. It's got the growth and it's got the staying power. I don't see Google search. I don't see YouTube. I don't see their products going away anytime soon. And so I feel like Google's got some good staying power. And it provides value in our lives. Like, I don't want to necessarily insult Facebook, because that's the other one that's at a reasonably good value, and I love Facebook so much. I have a subscriber who's kind enough to host me at Facebook a month or two ago. So grateful. The thing about Facebook that's a little different is you don't need that for business. So Facebook, it's more of a social network, but Google's about fun stuff too, but it's also about business. And so the reason I like Google, and if I had to pick Facebook or Google, I'd pick Google, is Google is literally needed to get someone's job done. It is used for business. And so that would be, again, if I had to pick a tech stock that did not pay a dividend. Certainly there's tech stocks that do pay a dividend that I would probably gravitate towards before Google, but someone asked me which one would I buy that does not pay a dividend. For me, it would probably be Google, aka Alphabet. So the PEs are in the 25 range, and next year down to 22. Not bad for this kind of company. And so this was just a fun little exercise. I highlighted the ones that I think are reasonable values. I got excited about Apple. That was a takeaway for me. I'll probably buy some more Apple in 2019. I want to raise it up. It's under allocated in my portfolio. It's a project stock. I just don't like looking at it. It's like housekeeping. I need to bring it to size. It just looks like it's kind of wrong. It's too small. So I got to figure that out with Apple. But anyways, what we did next is we started talking about tech stocks. Believe it or not, we talk about dividend values. We talk about FAANG. Then we move on and we're like, hey, let's just talk about some tech stocks. Let's talk about tech stocks of the world. And so, well, this is crazy. This is a dividend meetup, but the point I'm trying to make is I'm 100% dividends, more or less, in my mind. Yeah, I do other things like Bitcoin. I do other things like Angel once in a while. I am in real estate, but real estate I look at as dividends. It's the same thing. It's cash flow investing. I have been served well through focus because when I lose my focus, I have made mistakes before. I like to keep my focus because dividends is the one type of investing that has always held true. It's always worked for me. And so that said, maybe that's not for everything. And one of the things that the other investors brought to the table at the meetup was they take, quite frankly, a more balanced approach. And they're looking, hey, I love dividends. That's something I care about. But they weren't against other stocks, for example. They weren't against FAANG. They're not against tech stocks. I would say it's a more holistic investing mindset. And so what I want to share with all of you out there, you got to find what works for you. And a lot of people here on the channel are new. Thank you for subscribing, by the way. And if you're watching now, please just click the subscribe button and the bell next to it. That is the best way you can thank me for producing this content, which takes an unbelievable amount of time, but I do it because I love you all. And this is my passion. I just love doing this stuff on YouTube. And so anyways, what was so exciting, we talked about tech stocks. I'm going to share some of the ones we discussed on the screen right now. I don't want to get into a lot of detail with these tech stocks, but these are kind of tech stocks, non-FAANG stocks, up-and-coming stocks, if you will. There's some bellwethers on here like Salesforce and PayPal, for example. But there are some newer ones, some smaller ones on here. And you can see they're kind of all over the board on their PEs. So that some of them, PayPal was down in the low 30s. You got something like Coupa up in the 800s. And then there was Roku, which has no PE because they're losing money. And it was just all over the map. And then you had Carbonite, but that one was kind of weird because it looks like, based on analyst estimates, they'll have a really low PE. But in the current year, they're losing money. And so I didn't really dig into it. But what I wanted to share with you is sometimes people ask, what's tech investing like? And this is a snapshot, quite frankly, of what it's like. Non-FAANG investing, more risky tech investing. And these are the kind of companies, quite frankly, where you need that leap of faith. If you're going to invest in these companies, oftentimes it's not only about the financials. See, for me, when I do my dividends, it's financial first. It's all financials. And kind of look, I guess the product and everything matters too. I got to love what I'm investing in, but the financials are really heavy. When someone's investing in stocks like these, it's kind of a leap of faith on the financials. It's more about the company, what it does. It's understanding what the company does. It's understanding the technology. And so if that's you, maybe tech investing is for you, but certainly it carries risk, because the risk is if you're wrong and the business model does not pan out, you're stuck with a company that has a PE of 800. And we all know that that's not sustainable over the long run. Maybe in the short run, they're telling a certain story. Investors have a certain faith that they're going to grow. But in the long run, no, that's not sustainable without tremendous earnings growth and revenue growth. And so just an interesting juxtaposition of different types of investing. But here's some leap of faith investing we talked about. Now, one of the other things we talked about, I'm going back actually to FAANG stocks now, is there is this concept of management. This was interesting to hear from the other investors. I'm seriously sharing some of my big takeaways, because I'll tell you, when I invest, I'm not saying one's right or wrong, but when I invest, yeah, I kind of care about leadership at the company, but honestly, I don't. And the reason I don't care about leadership is I'm talking about CEO. The CEO, honestly, is only going to be at a company so long. And if I invest in a company based on the CEO and the CEO leaves, I buy and hold forever. How could I do that? It just doesn't jive with my whole buy and hold forever philosophy. So for me, I usually invest in companies for the company. I don't care about the CEO. And quite frankly, I want to buy something where if the CEO leaves, they can be replaced with someone else and the company will be just fine. That's how I look at it. However, one idea that was surfaced at the meetup, and maybe this stems from this leap of faith concept and from this tech concept, is that, hey, one thing that was discussed in the meetup is that very much the CEO matters. And it was kind of this idea of bet on the jockey, not the horse. And so it's kind of like you're betting the horse maybe is the company. The jockey obviously is CEO. Tech investors, they're kind of looking at that CEO really importantly and at the team really importantly. And certainly that makes sense for some of these companies I'll show on the screen again that have these ridiculous PEs, because yeah, that CEO is really important because he better or she better figure things out and grow the company, or else the company just can't sustain these kind of valuations. And so I guess in these earlier stage companies, you really need to bet on the jockey. But even as it pertains to FAANG stocks, one of the things we discussed is some of these FAANG stocks have amazing leaders. Facebook has Mark Zuckerberg, Google, Alphabet has Larry Page and Sergey Brin, and Jeff Bezos over at Amazon. And so we talked about Tim Cook over at Apple, and how these companies actually have really good jockeys, and those are kind of the jockeys you don't want to bet against. And so I thought that was just an interesting takeaway, because yeah, I guess that is important, but honestly, especially for tech. But I've never looked at it that way. And I'm not saying I'm right or wrong or the other way. I think it's all good thoughts. It's all good things to consider when investing. But for me, it's always been about, boy, I want a CEO that we can replace really easy, because I want to buy and hold this forever. And I know the CEO won't be there forever. So I need a machine that goes on without the CEO. And so it was just an interesting way, different ways of looking at it. So one of the things we discussed next was this concept of angel investing. And so I'll go real quick here. I've done some angel investing. I've talked about it before. Usually what I've done is friends and family type stuff. Literally, I have a friend who comes to me who's starting a company. I believe in the friend and I invest. And usually these are pretty big tranches, and my concentration of risk is pretty big because I don't have too many in these investments. But when I do them, I put in a lot because that's just how they're structured. And so that's been how I've done angel investing historically. But one of the investors came to the meeting and was kind of curious about angel investing, curious about how I approach it. That's how I've approached it. But this same investor brought some ideas to the meeting as well. And there are other ways to do angel investing. And so some of the ideas that we discussed were there are platforms on the internet where it basically democratizes angel investing. It allows people to spread their wealth around a lot of different angel investments, get access to angel investments in a new way that was never possible before. Because I'll tell you, back in the day, say 10 years ago, if you wanted to be an angel investor, you would probably do what I did. Literally friends and family, network your heart out, find people invest in them, put a lot of money in them, maybe not have enough diversification unless you just have a ton of money and that's a full-time thing you do. But what's cool about some of these newer inventions, and some of the ones discussed are WeFunder, FoundersClub, were two in particular. You can sign up on these websites and you can invest lesser amounts of money and you can spread it, you can diversify. And I'll tell you, if there's one thing I've learned as an angel investor that or with investing in general, is diversification is really important. And one of my pet peeves with the angel investing I've done is it's very non-diversified. I have a huge concentration of risk in the various investments. Now, mind you, huge concentration of risk when I talk about the angel portfolio, which is a very small portfolio considered to what I'm doing in dividends. Not something I'm actively trying to invest more money in either, by the way. It's more of a kind of side hobby, if you will. And what my plan is, by the way, with the angel investing is, if I get a real huge winner out of that, take the money, redeploy into dividends or cash flow, real estate, whatever. But anyways, I've always approached it that way. I've always approached it these big chunks, friends and family. But if I had one wish for my angel investing, I'd kind of want to do it more Ashton Kutcher style, which is just spreading it across like 200 investments. But I'm not at the scale where I can do that. The angel stuff's just, like I said, a smaller portfolio, small side hustle, small hobby for me. And so what was cool about this meeting is these two concepts that were discussed, WeFunder and FoundersClub, they could provide a means of doing that. Now, am I going to go sign up for these? Probably not. It's just not my thing. I'm focused on dividends 100% these days. I got some angel stuff. I am adding a little money to Bitcoin, which I kind of view as an angel investment, if you will, or a tech investment, speculative investment. But that is really not my bread and butter. But anyways, that was something discussed. And one other thing that was discussed was just local angel clubs. So if you want to be an angel investor at home, there are local clubs that you can sign up for, meet up with other like-minded investors, and actually take on angel investments as a team. Sounds like a good idea to me if angel investing is the thing that you want to do. Now, again, though, I'm just going to talk about myself here. If there's one thing, though, I've learned through any type of investing is focus, focus, focus. Look, if I want to be an angel investor, kind of what I concluded is I shouldn't be dividend investing. I should only be angel investing, and I should be the best angel investor possible. Because that's not what I'm doing, because I have a passion for dividends, I'm going to live off of dividends. I'm a cash flow guy. It's in my heart. That's what I do. Angel, it's kind of a smaller, separate thing that I've done. And what I've learned over the years is that's not always ideal. It's not ideal to spread yourself too thin. And so what I've kind of rationalized is going forward, probably not doing a lot of angel anymore. Now, I'll tell you one other thing we discussed was this concept of being an angel investor by picking your job or your employer really wisely. This is how I've actually profited and done very well in my career, is careful to work at startup companies that were growing really quickly, and startup companies where I had an opportunity to receive equity in the companies for my hard work. That is an angel strategy that has worked really well for me. Let's say you're a dividend person, you kind of want exposure, if you will, to angel. One way to do it without becoming an angel investor is just to work at the right companies. So that's been another hack, another strategy of mine that I've used over the years. Anyways, I want to keep going. Ton of ground to cover. Like I said, this was a very productive meetup. So we talked about Bitcoin just a little bit. What I was discussing was actually my own experience with Bitcoin. I guess Bitcoin is my own leap of faith. I'll tell you the reason I like Bitcoin. One, I've read the books. Andreas Antonopoulos, check out his books. They are amazing. I followed Anthony Pompliano. Check him out on Twitter. I subscribe to his newsletter. A lot of good value in there. And we discussed that at the meeting. But what I really like about Bitcoin is trends. And I see a trend. I see a few trends. I see VCs pumping a ton of money into Bitcoin and Bitcoin startups. I see pension funds now starting to sign up for Bitcoin and include, I'm talking about like pension funds, university funds, endowments starting to have allocation to crypto. It's becoming a recognized asset class. The reason I see that, going back to Anthony Pompliano, he works at Morgan Creek Capital with Mark Yusko. They have Bitcoin and crypto funds. They have venture funds, and they've reported in the past even some information that is sharing basically that endowments and trusts and pensions are starting to invest in crypto. So I like that trend. But what I like perhaps the most is the trend of younger people. I'm not talking about millennials. I'm talking about real young people who are adopting this technology and have different ways of looking at things. This is something we'll talk about this later in the video in the Peter Lynch segment. One of the things that all of us should always be doing is not only observing our own peer groups, but looking at people older than us, and especially people younger than us, and understanding what they're doing. And what I notice with younger people is, one, they're always at Starbucks, but two, there's this adoption and this idea, this notion that Bitcoin is a good thing. And so for me, I'm taking a leap of faith with it. I have a very small allocation. Like I said, I kind of treat it like an angel investment. It's off on the side. I always allocate very prudently to it. But that was something we discussed in the meeting, being in Silicon Valley. Want to talk about Bitcoin? Share in the comments below, by the way, what you think about all of these things, because I know I'm bringing up a ton of stuff today. It's a little different than what I've done before because it's just new insights, new ideas, new thoughts from our meetup. So moving on, I talked about Bitcoin. I talked about the younger people. One of the things that I thought was really cool is one of the investors that showed up brought up this idea of Peter Lynch. If you have not read Peter Lynch's books, please do so. They are amazing. They are my favorites. I love Peter Lynch. He's probably one of my favorite, if not the favorite investor. He will ask me like Warren Buffett. Warren Buffett's cool and all, but I like Peter Lynch more. And so I'll tell you, what Peter Lynch does is he invests in what he knows. He invests in what he knows really well. And he did very well doing that, running Fidelity's Magellan Fund. And he's written books on this. What was brought up in the meeting today was, hey, team, dividend investors, did you know there are some trends happening out there that you might not be aware of? And one of them that was brought up was this concept of the VSCO Girl. I'd never heard of this, so this is why I go to these meetups. But basically, what a VSCO Girl is, you can look this up on Google, VSCO. I guess that's an app. VSCO is an app. It's like a photo editing app. But apparently, a lot of younger, like teenagers and girls, they use this and they're called a VSCO Girl. But what they also do is they do a lot of other things together, like the same as their peer group. They all like to go to Starbucks. And I see this. I kind of knew this in the back of my mind because I see this. I work at Starbucks. Honestly, probably like 4 days a week I'm at Starbucks or more. I mean, I drink Starbucks, honestly, at this point, like 6-7 days a week. And so talk about sin stocks. I don't know, but I love my Starbucks. But anyways, I see them every day because when school gets out at a certain point, the kids flood in, and it's younger kids. It's real young kids. And so these VSCO girls, anyways, they like their Starbucks. They wear these oversized t-shirts and they wear scrunchies and puka shell necklaces. And so I'm serious. This is the stuff I look up on Google. You can't make this up. This is what they do. That's their thing. Good for them. And so everyone always thinks like that they know what's best. You don't necessarily know what's best. When you're an investor, you want to invest in the masses. You want to invest in what society is taking advantage of and what society is doing. And one segment of society that's very big right now, that's only growing, at least in the United States, at least, is this concept of the VSCO Girl. And so if you're an investor, you might want to go out. And I think sometimes when you're older, you're like me, late 30s, maybe you become a little too confident. And this goes back to being humble. You got the hubris and you're like, VSCO Girl, what's that? Sounds kind of dumb. I'm not going to look at it. Well, that's a mistake. If you don't look into that, you're leaving money on the table. And so what I love about these things is I'm going to remain humble. I'm going to look into what this is. I'm going to have an appreciation for this segment of society who I know nothing about. I'm going to see what kind of products do they like? What do they do? What do they believe in? Because that can help me as an investor put my money into the right things. And this gave me a lot of confidence in my Starbucks. But I already knew that because I see them at Starbucks every single day. Now, one of the other things that was brought up was this whole idea of the Becky index. I thought this was interesting. And so Becky, I guess, is just like a name for kind of like your average like Caucasian female in US, kind of like your average female in the United States, if you will. And so this concept of the Becky index is, hey, This is a big segment of society. This is a segment of society that controls a lot of money. This is a segment of society that spends money at stores. Why not look at the types of companies that they support? And so I looked up Becky Index on the internet. There was a good thread actually on Reddit that talked about all the stocks that would be reflected with this type of consumer. And so the takeaway for me and for you and from everyone for this meetup is, hey, one, don't discount certain younger generations. I think that's a horrible mistake that older investors oftentimes make. And it's getting too much hubris. So it's not discounting them. It's being humble. It's showing respect for them and understanding these trends, because these trends can help you pick really well-performing stocks, just like Peter Lynch did. And so sometimes I'll tell you, when you're a parent like I am, my kids are really young now, so they're not buying stuff yet, but they're gravitating towards certain products. And so as a parent, this is another way to understand these trends like the VSCO Girl better, because you may have a daughter who's at that age and is into those things. And why not just sit down with your kids, ask them about their beliefs around these different companies and the trends, and they could probably give you better insights than you will even come up on your own. So I really enjoyed talking about this stuff at the meetup. So moving on, we talked about something else. We talked about activist investors. I want to share on the screen here. These are some of the stocks I own that have been really approached by activist investors. And if you know, on this channel, I give the activist investors so much trouble. I harp on them. I don't like them, this and that. I'll tell you, it kind of comes from an area of, I'm a business operator. I have a lot of belief that, or I'd say a lot of confidence and a lot of belief that the business operators are the ones who should run a company, not finance people, aka activists, because activists come in, they're kind of short term, they're finance people, they mess things up. That's kind of my belief. But what was funny in this meeting, and I've shared this before, you've been around here, you know I say this. What was funny about this meeting is it kind of challenged me to think about my notion of activist investor. Ian, are they really all that bad? And so what happened is one of the people who attended the meeting has a finance background and was saying, hey, these activist investors, honestly, they're not so bad. In fact, oftentimes they shake it up enough. They give people at the company that's kind of stuck in a rut a free pass, if you will, to start bringing up new ideas and do the right thing. And so that was interesting. And so I started looking at some of my companies, and I was like, you know what? You're kind of right. Like a lot of the companies I have, they had an activist come in and they emerged from the activist much better off. And so I'm going to share these on the screen, like Air Products and Chemicals. I don't have the chart here, but this is this one company I own where Bill Ackman came in. He transformed the company. It's done really well ever since. It's been through the roof. It's been a great performing stock. Campbell's Soup, we talked about this a lot last year. Dan Loeb and Third Point came in. I was kind of fighting them myself on the proxy. I was fighting in favor of the company. I'm actually still glad I did that. I will always side with the company no matter what. I don't care what the activist says. I will always side with the company. Thug life. But that said, hey, maybe they shook things up just enough, because Campbell's Soup has since recovered. And I had the fortunate opportunity to buy really low. And since then, I've recovered and stock's doing great. Maybe they shook it up enough. They sold off some non-performing acquisitions, refocused their energy. Hey, Procter & Gamble is another one. Nelson Peltz came in. I think he's still involved. I think he was advocating for a breakup at one point. So that's why I don't like the activists. Sometimes they come in too extreme. But hey, it looks like P&G and Nelson are meeting in the middle. Look, P&G is doing really well right now. It's one of the best performing stocks this year, but just last year in 2018, it was not doing well, and I was loading up on it. United Tech, Bill Ackman is involved with this one, and he's involved, I believe, with the split up. I don't like the fact that they're splitting, but time will tell. Are they doing the right thing or not? And so just what's interesting is if you have a belief like I do, hey, activist investors are wrong, they're bad. It was just refreshing to hear from the community, hey, I understand, Ian, where you're coming from, and I'm never going to change that philosophy, by the way, because I always side with the company. But, you know, they play a role, and by having them in some of my companies, they've shooken things up enough to kind of get them out of their rut, get them out of their bureaucracy, and take things to the next level. So it's exciting to see that that happen with these activist investors. So we're going to close out now. I'm kind of at the end of this. We talked about, I want to go over two more things. This is an important message, actually, just like public service announcement. Here on YouTube, a lot of people share affiliate links and they're hyping up these free trading platforms. I like these free platforms because they've attracted a lot of new investors who may have never invested without them. Great. But what I'm saying is I believe the conversation sometimes is one-sided because a lot of the people pushing these platforms, they're looking to make affiliate commissions on the platforms. And so I believe the conversation is a bit skewed. And so one of the things we discussed at the meetup, I'm not trying to put down the platforms either because like I said, I love them. They got a lot of people investing who never would have invested otherwise. They don't have commissions, this and that. Good. Great. Everyone choose the platform that's best. But one of the things that we discussed is, hey, nothing out there is free. Nothing's free. And so if the platform's free, you better be reading the fine print and see what they're doing behind the scenes with your data, with your privacy, to understand how they're making money, because nothing's free. And so I thought that was just a good tidbit. It kind of backs up why I kind of remain platform neutral here. I don't want to push one platform or another for this very reason, because I don't want to skew a conversation. Now, one of the last things we just talked about was, hey, ADRs, American Depository Receipts. These ADRs, worth noting, have a management fee associated with them. It's a very small management fee, but they have a management fee. So I own a few ADRs. I own, what do I own? Like stocks like Unilever. I own like Royal Dutch Shell, Class A. And so I own a bunch of other. I've discussed them here before. But the point is that, hey, you may not know, but ADRs, it's a very small fee, but they do have a management fee because there is a transfer agent, like, for example, a Citibank, if you will, who is in charge of the ADR, and they get paid to sponsor the ADR. So that was something worth noting from the meetup as well. All right, everyone. There was more, and I could go on. This was a 3-hour meetup. But these were some of my big takeaways, some of the things I wanted to share with the community. I look forward to more meetups, more around California, more in the Bay Area. Eventually, I want to do some out of state as well. So it's on the horizon. I've kind of got that idea in my mind. It's hard for me because I have a family. I have limited time and ability to travel. And quite frankly, traveling can be expensive. So I wanted to save my money and put it in dividend stocks like Altria, which is trading at just an amazing 8% starting yield, and AbbVie, which is going to raise their dividend, I believe, sometime soon. And so I want to save my money for that stuff. But that said, that's on the roadmap as well at some point, hopefully. And I just want to thank you all. If you enjoyed the video today, please subscribe, like, comment. All that means the world to me. Before I leave, in terms of full disclosure, I am long on a lot of the stocks I discussed today. I am long Altria, ticker symbol MO. I own that. Philip Morris, PM. 3M, ticker symbol MMM. AbbVie, ABBV. Johnson & Johnson, ticker symbol J&J. Apple, ticker symbol AAPL. And McDonald's, ticker symbol MCD. Procter & Gamble, ticker symbol PG. Clorox, ticker symbol CLX. Air Products and Chemicals, APD. Campbell's Soup, CPB. And United Technologies, ticker symbol UTX. I own all of those stocks in my personal dividend stock portfolio. Also, before I leave today, in terms of a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for your fun and entertainment. All right, I hope you enjoyed the long video again. I'm doing them long on purpose because I know a lot of you appreciate that and ask for that. I'll see you all in the next one.